Hello, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation, timely for this time of year, and we're excited to have Sheldon Sweeney be our presenter. And here's a little bit more about our presenter today. Sheldon Sweeney is a financial advisor with Snyder Financial Group. He enjoys helping families who are planning for retirement, as well as business owners who need advice on creating an exit plan while protecting the business they have built. He also specializes in serving families with special needs. Sheldon holds 3 designations: the Chartered Special Needs Consultant, Retirement Income Certified Professional, and the Chartered Financial Consultant. He is also life and disability licensed. And Sheldon, we're glad to have you back. And I'm going to go ahead and turn over the time to you.
All right. Thank you, Marche. And thanks for being here today. I know you were just getting over a cold and you said your voice isn't 100%, but I really appreciate you because this is a timely topic. And my goal today is just to present some historical data that directly has to do with midterm elections. And this data comes from LPL Financial. I didn't want this time period to go by. I think you can have a positive slant on this. My goal is also not to express my opinion about this, but just to put this historical data in front of you, and I think it'll help calm some nerves. So this year for the stock market, there's been way too much for the stock market to digest, which explains the volatility. As we came into 2022, we know again from historical data that any midterm election cycle year is far more volatile than any other year in a presidential cycle, and we have seen that over and over again this year. So it's kind of like you name it, it has happened this year. Of course, baseline, okay, midterm election cycle year, built-in volatility, guaranteed. But then you add in the war in Ukraine, you add in inflation, which has just been nagging us all year, and then very aggressive moves by the Federal Reserve to hike these interest rates so that, the stock market is just like this. Part of the reason that the stock market is volatile in a midterm election cycle year is because of the unknown of what will happen on the midterms election. So anytime there's unknowns, it makes the stock market jittery, and that's historically proved out. So let's have a look at a couple of the data points here. This chart is saying it's highlighting what happens in October. So we just finished October. So October in a midterm year has very strong returns historically. This chart goes all the way back to 1950. So the way the color codes work on this, and again, this is from LPL, which is the clearing firm that we use here at Snyder Financial Group, but this data is just directly from the S&P 500 index, and it's looking at average monthly returns going all the way back to 1950, and then sorting it out across the month. So the blue bar is the average return per month since 1950. The yellow is our past 20 years. The orange is the past 10. And then since this is a unique year, a midterm cycle year for the political season is the gray bar. So let's just go over and look at October on the right-hand side where you see that orange arrow pointing down. And you can see in a midterm election cycle year, October has just been very friendly to stock market returns. We literally just saw that. We're recording this on November 4th. October closed out and indeed strong numbers again. So this is showing the average going back to 50. So it's 2.7% on the average return in October. Have a look at September, because we are all gritting our teeth and there was a lot of consternation about the stock market, but using historical data to calm our nerves, September historically is a down stock market month. So hopefully I can just present this data in a fact that can calm our nerves, because we have, as human beings, we're very susceptible to recency bias. So recency bias just means in our short-term memory, what do we relate this to? So when we hear day after day stock market report, oh, it's down again, it's volatile again. Okay, that's today's news. But what has happened over the past few decades, here it is. It's right in front of us. We should not be overly surprised. So let's move forward into the next point.
Yeah, I just had a question here. So this is an aggregation data of the past 50 or so years.
Yes.
Okay.
Yes. Aggregated data and showing the averages in a given month. So fortunately, with the recording, you can come back and study this slide at your leisure. So since we know that we can see historically what's gone on in different months, I wanted to paint another picture here about what happens in the 12 months following those midterm elections, which are coming up within about a week here. So early November, we have these midterm elections, and this is a first term for our current sitting president, which is President Biden. But I think you'll be surprised on this next slide. And the reason is that we can almost never use the word always, okay? Because there's nothing guaranteed in the stock market. You literally have to go over into life insurance products. If you have a product with guarantee, it's typically an annuity, sometimes a life insurance product, but you can never use the word guarantee in the stock market. So the fact that this slide says always, the only reason we could put that on there, or that LPL could put that on there, is because it's historical data. So here we go, back to 1950 again. What are we looking at? The red and the blue is Democrat and Republican Party. So the blue representing the Democrat Party sitting president, the red, the sitting president for the Republican Party. So one clear observation is that the stock market is very agnostic to which party is in control. You can see there's a green average there of a gain of 14.7%. And that's referring to the S&P 500 index returns the 12 months following a midterm election. So there's our average. And then you look at the difference between political parties, there's nothing. And that is proven over and over again with historical data. So what we're looking at here is bars that just represent these midterm cycle years and all the positive returns. There literally has not ever been a negative S&P 500 return year in the 12 months following a midterm election cycle. So this is what we're on the precipice of. Granted, we're fighting inflation. Whether or not we have a shallow recession remains to be seen. But if we look at historical data, we've got a pretty strong case here that even if it's a small positive, as there was in 1986 or in 2010, 2010 is an interesting one to look at because we had the Great Recession coming out of 2008. So kind of interesting that that's a data point on here. So it's going to be really, I think, kind of wonderful to watch the next 12 months unfold with I'd say, a hint of optimism because of this historical data.
That's very interesting. I'm excited to see what happens.
And then this, again, historical data, regardless of party, regardless of president, when you have a new president, and we'll just start with our current president. So President Biden was sworn in on January 20th of 2001. So this would be his 4-year cycle. And in the first midterm election cycle, which he as sitting president is coming into, there shouldn't be any mystery that the seats will change out. And that's what if we go back and let's look at 1922. Probably not too many people remember President Harding, but he lost 77 seats. in the House. We come forward, let's look at Barack Obama. In 2010, lost 63 seats, and in his first presidential cycle as sitting president, and again, Donald Trump in 2018 lost 41 seats. So it's very predictable. The two outliers were George W. Bush in 2002 and FDR back in 1934. But the average loss of nearly 30 seats, there it is. It's just historical data. So it's kind of funny to me that, I mean, this is just an observation of the data, that the stock market actually gets concerned about this and thinks that something different might happen, because it's pretty much going to be a changeover of seats. So what's super interesting about that is the stock market loves predictability. So when you have opposite parties in the presidential and the House, which I guess this is my personal opinion, but that's why I love America. We have this balance of power, things switch over, so be it. But it causes kind of a gridlock situation. So there's not going to be a lot of laws getting passed. Stock market goes, cool, we're in stability. Tends to be the reason the stock market's good the 12 months after a midterm election, because this happens. Parties switch over in the House, opposite from what the sitting president is. And then here, let's focus here on the blue bar. So the blue bar is for a new president. So currently President Biden. So you can see year one, again, this is looking at S&P 500 index returns and what happens year one. So we're in his year two right now. Not an awesome year because of many more variables than just this. But if we just look at sitting president, what happens on their 4-year cycle. In year two, 2.4% is the historical collected data. Look at years 3 and 4. Years 3 and 4 for the 4-year term of a sitting president. Year 3, year 4, positive, very positive returns for the S&P 500. So those are on our horizon. That's what we're leading into. So it's important to remember that when you hear the news, to differentiate what is economic news and what is stock market news. So even if we go into a shallow recession, the market tends to turn around before that recession is over and head back in a positive direction. So because of this midterm cycle point that we're in, I think there's a hint of what do you call it, a silver lining. And because it's historical data, Mark Twain has this wonderful quote. He said that, and I'll paraphrase, but basically that history doesn't repeat itself, but it often rhymes. So we can't use this to predict the future, but you can see the patterns, hopefully, of what's going on here. And then I think we just have a final slide.
Yeah.
So
any final thoughts before we close this out? I know this has been short, but we do want to give people this information.
For sure. No, the intent, I wanted to keep it short. There's so much noise and everything out there. So I just wanted this to go into circulation to give people another just little glimpse at the historical data. So take a moment, maybe go back and focus on some of those slides to kind of digest what the history collected from the stock market shows us. Thank you for listening.
Well, thank you so much for being here, Sheldon. We really appreciate you and the organizations that have made this webinar possible. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.